Hello everyone, this is Terry with Futures.io. It is my pleasure to welcome back Al Brooks for today's webinar, Opening Breakouts and Reversals. If you have a question in the webinar, please feel free to type your questions into the questions box and we'll do our best to answer them at the end of the event. Also, if you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I will hand it over to Al. All right, Al,
Hi, Terry.
you should get the pop-up.
Are you? Okay, are you able to see the screen, Terry?
Yes.
And you can hear me?
Yes.
Okay, great. And you do not see the
No, not at the moment.
little webinar icon. Okay, good. Let me get started. Well, I want to thank Terry for having me, and I especially want to thank Big Mike and Futures.io. I'm Al Brooks, and I'm going to be talking today about trading the opening, breakouts, and reversals. Most of the slides come from my video trading course, and I also created a lot of other slides that I regularly show in my chat room. And so some of the slides will be familiar to people who are watching this. I want to make some points during the presentation today. A very important one is on the open. The market often has a very strong breakout up or down, and sometimes the breakout is in two different directions. It's very important to realize that the market is searching for the initial direction, and 50% of the time, that initial breakout, no matter how strong it is, will reverse. Also, day traders know that the high or low of the day forms early in the day, and by 8:30 California time, by 8 o'clock California time, 90 minutes into the day, there's a 90% chance that either the high or the low of the day already exists. And that's important to know because it helps you with your trading throughout the rest of the day. I'm going to talk about two kinds of breakouts that occur during the open. One is what I call a breakout mode setup, and then the other is a breakout of the range of the first 18 bars. And then there's another pattern. If I have time, I'll talk about that as well. And that is if the market trades above yesterday's high or low and reverses, there are different ways to trade that, especially if you have a second entry on the reversal. And then finally, if I have time, I'll talk about a failed reversal. In other words, the market, let me rephrase that. I'll talk about trend resumption if you get a reversal that fails. So if the market trades above yesterday's high and tries to reverse down, but fails to reverse down, and the bull trend resumes. Here are two charts. Again, as I said, the market on every day usually has some kind of a strong move up or down on the open. And it looks convincing. For example, here, let me put up the pointer, the laser pointer. No, I'm not sure that it's going to allow me to do the laser pointer. I'll do it manually. Anyway, you can see a very strong bear breakout here. And as strong as it was, it led to a reversal up. And here's the opposite. We gap up and we rally strongly on the open. And no matter how strong the breakout is, there's a 50% chance that instead of leading to a continuation up, you'll get a reversal down. Although you cannot see the bars to the left, these breakouts are always a test of support if it's a sell-off or a test of resistance on a rally. Strong sell-off became the low of the day, and strong rally became the high of the day. At the close of any bar of the day, you can get an idea of whether or not the high of the day or the low of the day has already formed. For example, by the close of the first bar of the day, there's a 20% chance that it will remain the low of the day. There's also a 20% chance that it will be the high of the day. Depending on context, sometimes the probability can be as high as 30%, but in general, there's a 20% chance that the first bar of the day will either be the low of the day or the high of the day. By bar 7, there is a 50% chance that this is going to remain the high of the day or this is going to remain the low of the day. By bar 12, the end of the first hour, there's a 70% chance that you've either seen the low of the day or the high of the day. And in this day, this was the high of the day. There are 81 bars in the day in the E-mini. Bar 80, the next to the last bar of the day, you know there's a 99.9% chance that you've either seen the high or low of the day. And if the day is far below the high, there's a 99.9% chance this will remain the high of the day. Only one chance in 1,000 or one chance in many thousand that the market is going to go all the way back up to a new high in the final bar of the day. However, that does not help you as a trader. You know, big deal. You know this is going to be the high of the day, but that's not going to affect your trading. However, knowing something about when a 90% chance of the high or low of the day has taken place is useful as a trader. And by the 18th bar of the day, there's a 90% chance that either the low of the first 18 bars will remain the low of the day, or the high of the first 18 bars will remain the high of the day. And that does help you as a trader. For example, if the market breaks below that 18 bar low, there's a 90% chance the market is not going above the high of the day. And that means there's a 90% chance that the day will either be a bear trend day or a trading range day. And the opposite is true if the market breaks above the 18 bar high. Then there's a 90% chance that the day will either be a bull trend day or a trading range day. And knowing that encourages you to buy pullbacks because you know that there's only a 10% chance the market's going to fall back below the low of the day. There's nothing magical about bar 18. The more bars that you look at, the higher the probability that you've seen the high or low of the day. So bar 23, you know, it's better than a 90% chance that you've seen the high of the day or the low of the day if you get the breakout. Bar 16, it might be an 80% chance that if you break out of the 16 bar range, you've already seen the high or low of the day. But I like to use 18 because, you know, 90% chance is very, very high. And I want to know, did I see the high or low of the day? So I pay a lot of attention to what happens around bar 18. I want to talk about two types of breakouts on the open. And the first one I call breakout mode. And what I do is I look at the day at around the 10th bar of the day. I want to see if there's a reversal down from a new high. In other words, the market goes above the high of the first bar and reverses down. And I want it to go below the low of the day and reverse up. And that is a breakout mode situation. If it reverses up after reversing down, it can happen either way. It could reverse up and then down. The market's in breakout mode, and traders will look for some kind of a swing up if it breaks above the top of that range, or if it reverses up here and then breaks below, they'll look for a swing down. Here there's a bull breakout, and the breakout was strong. It's also around the breakout of the it's also around the breakout of the 18 bar range. And once you get that breakout, there's a 90% chance the day will either be a bull trend day or a trading range day. And you also look for around a measured move up, and the market went more than a measured move up based upon the height of this opening range. Again, this is bar 18, and we're breaking above the 18 bar range, and knowing that tells you that 90% chance this will remain the low of the day, and therefore if you buy, you can put a stop below that low. 90% chance it will not get hit. You'll either go up or you'll go sideways, and even if you go sideways, you can buy more lower, again putting a stop down here and having a high probability of making at least a scalp. This is not a breakout mode situation. We went below the low of the first bar, reversed up, we rallied and reversed down, but this high did not go above the high of the day. So this is not a classic breakout mode pattern. However, every day has 18 bars, and you look for a breakout below the 18 bar range or a breakout above the range. And once you get that breakout below the range, 90% chance this will remain the high of the day, or excuse me, this will remain the high of the day. We pull back a little bit and then we broke strongly to the downside. Odds are we'll get at least a measured move down or around a measured move down based upon the height of that 18 bar range. Bear breakout of that 18 bar range. So 90% chance you'll either get a swing down and a bear trend day, or it'll remain a trading range day. Here we had a swing down. The day became a reversal day. However, there was a good swing trade down. Again, as I said, this is not the classic breakout mode because this high did not reverse down from a new high of the day. I'm always paying attention to the high or low of the day, and it usually forms early, as I said. Again, this is a breakout mode pattern. After the first bar, we went above the first bar and reversed down, and then we went below the first bar and reversed up. As soon as the market reverses up, then we're in breakout mode. And theoretically, there are computers buying on a stop just above the high, and they will also place a stop to sell below the low. And if they get filled on the stop to go long up here, they'll place a protective stop on the low. Therefore, traders will buy on a stop above that high, expecting a measured move up. The bears tried to reverse down, they failed. The bulls tried to reverse up, and they're succeeding. And theoretically, the bears have their stop right above the top of this bear leg, and they'll give up. And that's why the bulls want to get long there. They know the bears are giving up. If the bears are giving up, they're probably not going to sell again for many, many bars. Again, look for a measured move once you get the breakout. Once you have the reversal down, and then you're at a new low, and the market's trying to reverse up, a lot of traders will buy the reversal up, taking a chance that we will get the breakout above the top of the range and the rally up. So you can often enter early. Here we have 3 consecutive inside bars. So it's an I. A lot of traders will buy above this bull bar, especially after this strong reversal up. Front running the bulls who will buy the breakout to a new high of the day. And that's okay. First bar of the day, we broke below it, reversed up. We broke above it, reversed down. However, the pattern does not have many bars at this point. The reversal down took place on about the 6th bar or so. And to me, that's a less reliable breakout mode pattern. I want the trading range to last 10 bars or more. Once the market falls below that bear bar, then you have a reversal down, and theoretically you're in breakout mode, except when the pattern is this small. A lot of traders wait for the pattern to grow and then look to see if there is a reversal down and a reversal up, and then they create their breakout mode pattern. So you can enter here, but the initial range where the reversals were was small, and it's a less reliable breakout trade here. The market rallied and stalled at this minor lower high and formed a double top bear flag. And there's a second entry, micro double top. We went up and down and then up, and then we're turning down again. And we have a decent bear bar. And this is also a reasonable short, selling a pullback from the breakout to the new low of the day. Once you get the bear breakout, especially if you get that second bear breakout of a bigger opening range, 90% chance the market is going to be either in a bear trend day or a trading range day. And if it's in a trading range day, you can sell rallies, taking a chance that you'll get a bear breakout, knowing that the probability of the market going to a new high is only 10%. Again, when the initial range where the 2 reversals take place is small, only 6 bars, a lot of traders ignore the first reversal and they start counting with the second reversal and then look for a third reversal. So they might ignore this reversal up and then say this is the first reversal, and then they look for a new low of the day and a reversal up, and it creates a larger breakout mode pattern. And traders then would look to sell on a stop just below that low or buy on a stop just above that high. And then we get short there. Again, small pattern. First bar of the day, we went to new low, reversed up, new high, reversed down. Only a 4-bar pattern. Traders are not going to be selling below the low or buying above the high on a stop. This is a limit order market. If anything, they'll be buying below bars and selling above bars, betting on reversals instead of breakouts. Traders will not trade breakout mode unless the pattern has more bars. And at this point now, 9 bars, it's around 10 bars, and it's more reliable to sell below here. It's still not a great breakout mode pattern. We have a lot of small bars, a lot of sideways bars with small bodies and big tails. It's a limit order market. Traders are selling above bars and scalping, buying below bars and scalping. It's more of a limit order market here. If they broke above the high, I think there probably are more sellers above. You have a 7-bar tight trading range filled with doji bars, bars with big tails, small bodies. It's a limit order market. Probably more traders selling with limit orders above that bar than buying with stops above that bar. And you can see it reverse down. And then the bull breakout failed. We got the bear breakout. After the first bar, we reversed up from a new low and now down from a new high. 9 bars instead of 10 bars. However, I think it's a higher probability trade after a bigger pattern than just trading after a 4-bar pattern. Again, when you have a tight trading range like this, buying with the stop at the top, selling with the stop at the bottom is usually not the best way to enter. It's better to wait to see if there's a strong breakout and then sell, or if there's a breakout and then a pullback and then sell. And your expectation will be less. If the market has a lot of early trading range price action and there is a breakout, the breakout is probably not going to go all that far. We have a breakout, big bear bar closing at its low, and a lot of traders will wait to see if the next bar is also a bear bar, at least has a small bear body, and then they'll sell that close. As soon as that bar closes, they'll hit sell in the market. Or some traders will sell a second before it closes if they think the bar will have a bear body. Small range, about half of an average day's range, and therefore traders will look for the range to double, and that means they'll look for a measured move down. And you can see a lot of traders bought right around a measured move. Some of these buyers are bears buying back their shorts, others are bulls buying, expecting profit taking from the bears and at least a tradable bounce. After the first bar, we have a new high, it reversed down. We have a new low, and it reversed up with a decent looking bull bar. We broke to a new high. Can you buy with a stop up here? You can. I think it's reasonable. It's also a breakout of the 18-bar range, and therefore we know at this point there's a 90% certain, a 90% probability that the market is not going below here, and that it's either going to be a bull trend or a trading range. And if it's a trading range, traders will buy pullbacks knowing that there's a 90% chance it will not fall below here, and they'll make money buying the pullbacks. Again, first bar of the day, we went below, reversed up a second time, went above the high of the day and reversed down, breakout mode. It's reasonable to sell below this bar. You have a double top bear flag below the moving average with a decent bear bar. And you have 2 legs down here, and now we have a bull bar forming a higher low. A very strong reversal up here, 2 bars, and you can call this a wedge bull flag, 3 reversals up, 1, 2, 3. It's reasonable to get out of shorts and to go long and front run the bull breakout up here. A lot of times when you're looking for a breakout on the open, you'll have to take 2 or 3 trades before you get a swing, and that's okay. The bears who sold here, they could stay short, even hold short here, and then get out on a stop above the top of the range up here, or they would get out over here. I personally, had I sold this, I would get out, and if I were flat at this point, I would get long, betting on a double bottom or a higher low major trend reversal, bear trend, bull breakout, and then higher low. Alternatively, you wait for the breakout and the close and simply buy the close, looking for some kind of a measured move up. Breakout mode traders, they can buy that bull breakout, especially since there's a big bull bar here, another big bull bar here, and we have a higher low, so it's a type of double bottom. We might break above the neckline and go up for a measured move. As I said, sometimes if you're looking for a breakout mode trade and you're front running, entering before the breakout, you have to take 2 or 3 entries before you get a swing. So selling below here, we reverse up, reverse down, good sell signal bar just below the moving average, a reasonable sell. And then it failed. We got a higher low, and a lot of the bulls will buy this, trying to front run the breakout above here, buying, hoping that we get the bull breakout and then a measured move up. Now, I want to talk about a breakout mode or a breakout of the 18-bar range. Now, I was talking a lot about breakout mode. Sometimes breakout mode is also a breakout of the 18-bar range. Here we have an early reversal down, and it's a second entry short with a decent bear bar here and again here. This is a reasonable short, and some traders will sell this hoping that we get an 18-bar range and then a bear breakout. So it's reasonable to take the short. This is bar 18, and therefore, by the close of this bar, there's a 90% chance that either this will remain the low of the day or this will be the high of the day. The bears who took this short probably are going to buy back their short here. We have a bull reversal bar. We had terrible follow through on the way down, 2 bear bars, a bull bar, a bear bar, a big bull bar, a bear breakout, and a bull bar. We have a double bottom, bull flag after a gap up. We have a gap up, a pullback to the moving average, a weak sell-off, probably a bear leg in a trading range, and we have a double bottom. And we're reversing up above the low of the day on the 18th bar. Sometimes the reversal will be on the 16th or 17th bar, sometimes the 21st or 22nd bar. In any case, if you're getting a reversal up from the low of the day, especially when there's a reasonable chance that we're forming a low of the day, we have a gap up and a bull flag, a wedge bull flag, and a good buy signal bar, it's a really good buy. Because once you get that breakout above this low, you're reversing up from the bottom of the 18-bar range, your risk is small and your reward is big, because if it breaks above the 18-bar high, 90% chance this will remain the low of the day and it might go up for a measured move. Reward much bigger than risk. Some traders prefer to enter on a stop on the breakout above the 18-bar range. At this point, once we went above that high, 90% chance this remains the low of the day, which means we're either going to go up or sideways. And if it's sideways, you can buy pullbacks and you can make at least some money. This is the 18th bar of the day, and therefore traders will either buy on a stop above the 18-bar range, sell on a stop below the 18-bar range, or since we're near the high on bar 18, a lot of traders will look to sell on a reversal down, especially if there's a small double top. We have a micro double top here, we have a bigger double top here, and we have a bear bar. Plus, it's a lower high after a sell-off that began with yesterday's close, into yesterday's close. So it's reasonable to sell on a stop here, front-running the breakout of the 18-bar range. If it breaks above the range, you can get out and take a loss, or you could reverse the long, or if there's a strong breakout, you get out on a stop just above the high, and then you look to buy the close of the breakout bar or the follow-through bar. And if you're lucky, this will be the high of the day or the high of the next several hours, and you'll be getting a really good entry for a swing down. very little risk, big reward, and decent probability. And once it breaks below here, 90% chance this will remain the high of the day. Sometimes here we got a slight new high late in the day. Sell the new low, 90% chance it'll remain the high of the day. Sometimes you get reversal days, and here we have a strong brief bear breakout and then a higher low after a strong reversal up. This is a higher low major trend reversal. But even then, the sell-off is so big, the market is unlikely to become a big bull trend day. When you get a reversal day and the initial sell-off is big, usually the market does not go above the high, or if it does go above the high, it does not go far above. However, you can get a swing up for the remainder of the day. You know, you hear, oh, reversal day, and you think, oh, it's going to become a huge bull trend day. Usually not. If the sell-off is big like this and you get a reversal day, usually the market has a hard time getting much above the initial high of the day. However, you can still get a decent swing up. Here we got a late high of the day. And as I said, most reversal days do not go far above the high. What about this? First bar of the day, we went up, we reversed down, we went up, we reversed down. And we have a decent bull bar. Okay, but this is bar 18. And by the close of this bar, this is bar 18 right here, by the close of this bar, there's a 90% chance that this will be the low of the day, or this will be the high of the day. However, this is a wedge bottom, good bull bar here, two good bull bars here, good bull bar here, and then bar 18 is a good bull bar. A lot of traders will front run the breakout to the new high of the day because the context is good. We have really good buying and we have a good bull bar here. So some bulls will buy above this bar, even though it's only about the 14th or 15th bar, taking a chance that will break above the 18 bar range. Other traders will simply look at it and say, hey, it's a wedge bottom with a good bull bar and we have good buying pressure with these bull bars as well. I'm just going to buy that. You can wait to buy a breakout, buy on a stop above the top of the 18 bar range, or you can buy pullbacks. We have a pullback here, a couple legs down, one pullback, two, a breakout to a new high, a couple legs down, one pullback, two, bull bar closing on its high, reasonable stop entry buy. After the first bar, we went to a new high, reversed down, we went to a new low, reversed up. But the pattern is too small and traders will not treat that as a breakout mode pattern. So they will not buy on a stop above, they will not sell on a stop below, they'll wait for a bigger pattern, like another reversal. Even looking at this as a second reversal, we went up, we went down, that is only about 7 bars and that pattern is too small. At this point, it's a bigger pattern and traders are more willing to buy a breakout. Or had it gone down, they'd be more willing to sell below. $10 range, now traders will start looking for second reversal or breakout mode. All right, so here's bar 18, a lot of trading range trading, sideways, sideways, a lot of prominent tails. The rally is weak. It lacks consecutive big bull trend bars. We have a bull bar, then a bear bar, a bull bar with a tail, and then small bull bars that are sideways. When you get the 18 bar breakout, yes, 90% chance this will remain the low of the day. However, when there's this much sideways trading, chances are we're not going to have a bull trend. Chances are the day will remain mostly a trading range day. Once the market gets to around bar 18, you know, bar 15, bar 20, bar 25, somewhere around there, if it's near the low of the day, traders will buy for a reversal up, hoping to get a breakout above the 18 bar range. If instead the market is near the high of the day, around bar 18, they'll sell for a reversal down, hoping to get a breakout below the low of the day and a measured move down. Bar 18, but look at the day. We went down, we went up, we went down, we went up, we went down. right? Is this likely to lead to a big breakout and a measured move down? Probably not. It's probably going to be a continued trading range day. And yes, it's the 18 bar range, but not a lot of traders will sell on a stop below the low. Not a lot of traders will buy on a stop above the high. And that's because all of these reversals, it's a trading range. And trading range day, traders prefer to buy low, sell high, and scalp. And therefore, if you're looking for a breakout, you're not going to be selling on a stop below the low of the day. You'll wait to see if there's a strong breakout and maybe a follow-through bar and then sell. Likewise, you're not going to be buying on a stop at the high of the day. You'll wait to see if there's a strong breakout and follow-through, and we did not get that. Instead, you'll be looking for reversals, especially micro double bottoms. We sold off, trying to reverse up, sold off again. So micro double bottom, here's the neckline. You buy above the bull bar, hoping that this failed breakout becomes the low of a swing up, which it did. If you want, you can call it an expanding triangle. We have higher highs, lower lows in a sideways pattern. And some traders will buy it simply because of the expanding triangle, not paying any attention to the 18 bar range. It's a double bottom near the bottom of yesterday's range and testing yesterday's close. Now I want to talk a little bit about a failed breakout above yesterday's high or failed breakout below yesterday's low. Really common pattern to look for on the open. In the final minutes, I just want to quickly go through some common open patterns that everybody should look for. They're important. This is yesterday's high, this blue line, and we reversed down. We broke above yesterday's high, reversed down, a bad sell signal bar. We broke above yesterday's high a second time, and now we're reversing down, and this time with a good bear bar closing on its low. This is maybe a 60% chance of a swing down, so it's a high probability short. A second entry for failed breakout above yesterday's high. First entry, second entry. And the opposite is true here. This, although you can't see all of yesterday, this was yesterday's low. We gapped below yesterday's low and reversed up, not a good buy signal bar. We broke below yesterday's low again and we're reversing up again, this time with a decent bull bar and a small double bottom. This is a reasonable buy, 60% chance you'll get a swing up. And the reward is going to be bigger than the risk, usually twice as big as the risk. All right, this is a variation of it. Here's yesterday's high, and we reversed down below that bear bar. We went up again, and now we're going down. This is an outside down bar. It did not go above that high, but it reached that high. So for me, that's a type of outside down bar, and it's a micro double top. We went up, we went down, we went up again, and we're going down again. And selling below this bull bar or below that bear bar is a second entry for a failed breakout above yesterday's high. Remember, no matter how strong a rally is on the open, there's a 50% chance it's going to fail. When the rally is very strong, a lot of traders will not sell the first reversal. They'll wait for a second reversal. So first entry is below this bear bar. We went to a new high. Second entry below that bull bar or below this bear bar. Trading range open. We have a gap up in a rally, and then we have a second rally, and now we have a good buy signal bar for a third rally. This is a very common pattern. We have a very strong breakout, gap up and very strong breakout, reversed up a second time, and now a third time. This is a wedge bull flag. This means it's a bull trend, and now it's a wedge and a higher low, so it's a wedge bull flag. If you want, you can call it a bull breakout and then a double bottom bull flag, just looking at these two. And anyway, in any case, you got to buy. You have a strong bull bar here, strong bull bars here, very strong rally here, and higher low. Is it an opening reversal? It's probably too late in the day to call it an opening reversal, but to me, I would call it a wedge pullback from a strong rally and a gap up. yesterday's high. Actually, yesterday's high is that high of that black bar, and we reversed down below yesterday's high, and we reversed up, high 2, up and then up. It's not a terrible buy here. However, with the doji bar far above the moving average, all of this trading range trading here, I would not buy above that bull doji. I would instead be looking for a second reversal down, especially below a bear bar. A breakout above yesterday's high, we tried to reverse down. We're still above yesterday's high. In fact, we went to a new high of the day, and we're reversing down again a second time with a bear bar closing near its low. That is a good trade, 60% chance you'll make some money. Not necessarily that much, but that second entry sell is a higher probability sell. All right, this is something that happens pretty frequently. Yesterday's high, and we reverse down below the bull bar. And you can say the second entry is below this bear inside bar. I don't know. To me, this is a better second entry sell. We have a small double top, a very good sell signal bar. But if you take this short and you're looking for a swing trade, where's your stop? Probably one tick above the high of this good-looking sell signal bar. And what happened right here? Well, it did not get above that high. It double topped with that high. It did not hit the stop. Some traders might get out above this bull bar, hoping that it's a bull flag, bull breakout, 2 legs down, decent bull bar. And that's reasonable. You could get out. But if you do get out, and then you see the market not hit the stops for the bears who did not get out, and then we got a bear bar closing on its low again, you'd go short again. And for traders who did not do anything in here, now they have a double top lower high, good sell signal bar here, and good pattern here, second failed breakout yesterday's high, and now they have another entry, and the bulls were unable to run the stops on these bears. So we're probably going to fall for a swing down. Yesterday, we broke above yesterday's high and reversed down below a doji bar. Not a great sell. It looks like the kind of bar that you'd expect in a tight trading range. However, we broke again above yesterday's high and we're reversing down a second time, and this time with a bear bar closing near its low. That is a higher probability sell. The bears did not get a strong trend. They probably would get out above this bull bar, 2 legs down, 1 pullback 2 in a trading range. But if they did, they can look to sell again near the top of the range. And here we have a wedge lower high. We have first push up, reversal down, second push, third push, and then fourth push. You know, this is a wedge, and it's part of a bigger wedge. And you have a bear II, consecutive bear bars closing on their lows and a lower high. It's a reasonable sell. It might simply be a bear leg in a trading range, but you're selling near the top of a trading range. And you had a good sell at the start of the day. We're after bar 18, so at this point, you know there's a 90% chance either this will remain the low or this will remain the high, and you're selling right near the high, so there's not much risk and there's pretty good reward. Wedge bottom, had you sold, you'd get out here on a second entry buy. It's a breakout below yesterday's low, first reversal up, and now second reversal up with a good buy signal bar. And therefore, if you're short, you get out of the short, and if you're not short, you can buy. If you prefer, you can buy after a strong reversal up. We sold up, we reversed up, and we have a pullback. Does not look like a bear reversal. It looks like a bull flag after this reversal up, so and a good buy signal bar. Again, a gap down below yesterday's low, we reversed up, it failed, and now we're reversing up again a second time. So this is a second entry for a failed breakout below yesterday's low with a decent buy signal bar. And if you want, there's a third buy signal bar here if you did not take the second entry, or if you want higher probability, you wait until you get a couple strong bull bars closing above their midpoints and then just buy the market on the close of that second bar. Break below yesterday's low, tried to reverse up, failed, and now we're getting a second reversal up with a bull bar closing on its high, reasonable to buy on a stop above the high of that bar. There are other things involved here as well. The bottom of a bear channel. Bear channel is a bull flag, and therefore you can call it a wedge bottom. And it's also a double bottom with the low from 2 days ago, and that increases the probability that you'll get a swing up. And then a small bull flag, pullback from the initial rally. And then lower high in a wedge, so reasonable to get out of longs or to short there. I want to scroll through quickly because I want to make a point and I'm running out of time. Another second reversal up from below yesterday's low. Yesterday's low, first reversal, second reversal. Yesterday's low, first reversal, second reversal. Big up, big down, big confusion. Market's probably going to go sideways for 10 or 20 bars, maybe the rest of the day. Yesterday's low, reversed up, and a second reversal up. The bears then had a wedge bear flag at the moving average. They might sell below this bear inside bar, looking for a swing down. But if they did, they would probably buy back the shorts here on a second entry buy, one, pullback two. Higher or low, major trend reversal. If you want, you can call it a double bottom. And then we got a bigger double bottom later in the day. Okay, I want to talk about one last thing before I take questions, and that is trend resumption after you get a failed reversal. So this is yesterday, we reversed down, and now we have a second reversal here or here. Let's say you took that short, what do? Well, we're holding above the moving average, now we have a triangle, 3 legs down, 1, pullback, 2, pullback, 3. A lot of the bears who took that short would get out here, and they definitely would get out at a new high of the day, which would also be a breakout above the first 18 bars of the day, hoping for a measured move up. This is a reasonable sell setup, but instead of selling off, the bull trend resumed. And therefore, you have to get out of shorts and you have to get long. And then we're getting gaps. This low, that high, this low, that high. This is a small pullback bull trend day, and it's probably going to go up a long way. And therefore, it's a swing buy. Traders are looking to buy for any reason. Below bars, above bars, bear closes, bull closes. And then we have a buy climax late in the day with a bear bar closing on its low. Traders would get out here. Aggressive bears would sell here. This is a buy the close finish that started too early, unlikely to make it to the end of the day. And therefore traders, longs would get out below a bear bar, and aggressive bears would sell for a scalp at the end of the day. Yesterday's high, reversed down a second time. But instead of going down, we have a gap up and it's a bull flag. So it's a failed reversal. And because we're not going down and instead are immediately reversing up, bears will get out and bulls will start to look to buy. Later in the day, we have a reversal down, second reversal down, trying to get a third reversal down. A lot of trading range price action, probably a bull leg in what will become a trading range, and therefore traders will look to sell, especially if you get a second entry. First entry below a bull bar, not good. Now we have a bear inside bar closing on its low, higher probability for possibly a swing down. Failed breakout below yesterday's low, immediate reversal at the 60-minute moving average, reasonable buy. And here's a second entry buy. Yesterday's low, reversed up, second entry buy, but then look what happened here. We're getting a wedge reversal at the moving average. So the bears see this as a bear flag. A gap down and then a pullback. And it's a bear flag at the moving average with a decent sell signal bar. The bulls who bought here or here will recognize that and they'll get out of longs, and bears who are flat will look to sell that for a possible swing down. And instead, we got a lower low major trend reversal. You can call it a double bottom. And the bears would get out above this decent bull bar. aggressive bulls would buy, or they'd wait for a couple strong bull bars and then buy a close or buy a pullback. All right, so that's all I wanted to say. I wanted to make the important point that on the open, you very often get a strong leg up or down, but anytime you get a strong leg on the open, 50% chance that first breakout will fail and reverse. Next, the high or low of the day forms early in the day. 90% chance that the high or low of the day will be present by the close of the 18th bar. And by the end of the 18th bar, traders are starting to look for a breakout of that 18-bar range. I also talked about a breakout mode setup, which means after the 10th bar, if you have a new high of the day that reverses down, a new low of the day that reverses up, either one can come first. Traders will look to enter on a breakout of that initial range. And then I talked about failed breakouts above yesterday's high or from below yesterday's low, especially if you get a second entry buy up from below yesterday's low, or a second entry sell from down from above yesterday's high. It's a high probability trade, 60% that you're going to make money if you manage it correctly. And then finally, any pattern fails. So if you're getting a reversal from above yesterday's high or up from below yesterday's low, it can fail. If it does fail, you'll probably end up getting a trend. I'm Al Brooks. Thank you again for watching the webinar. And I also want to thank Terry, and again, I want to thank Big Mike and Futures IO. Now I will take questions.
Okay. Let's see what we
Terry, there may be a whole bunch of questions, so it might be better if you read the questions to me.
Yes, I will read them out. Let's see. With more and more of the ES volume being traded by computers, do you think the decreased volatility we've had for the last several months is a new normal?
No, that's funny that you talk about that new normal. I've been trading for over 30 years, and I cannot tell you how many times I've seen some professorial expert on television announce it's a new normal, the markets are different, and it's just total nonsense, right? There are subtle changes that take place, but if anything, the markets are just becoming more perfect. Traders, long before computers, were trading rationally, and the computers are not more rational, they're just faster. So if anything, they make the patterns that were present forever more perfect. And this low volatility that we've had over the past month, to me, is usually a precursor to very big volatility. And because the weekly chart and monthly charts are so climactic, it's much more likely that we'll get a surprise down than a surprise up. So I think the low volatility that we had is going to change. The market goes through cycles where it has very low volatility, very high volatility, and it's going to end. It's going on for a long time. And now we've had 12 months where every low on the monthly chart is above the low of the prior month. And that's only happened once before in the past 50 years in the S&P, and that was 1995. It led to a huge bull trend. 13 months of bars in a microchannel, 13 months with every low at or above the low of the prior month. It got a pullback, about a 10% pullback, and then a resumption up. The point I'm making is that now we're at 12 months. The longest in the past 50 years was 13 months. How much longer do you think the current behavior is going to continue? I don't think it's going to continue much longer. In fact, there are other things going on right now that make me think we're probably going to get a big surprise sell-off, certainly by the end of the year and possibly within the next few weeks. Even if we do, it'll still be a bull flag. The weekly and monthly charts, yes, they're climactic, but they're so strong, the odds are bulls will buy the breakout, or bulls will buy the reversal. So if we do get a correction, it probably will only last 1, 2, or 3 months. So sorry about that long-winded answer. Okay, Terry, what do you have next?
All right, let's see. All of the bars on your charts are 5 minutes?
Yes.
Okay.
Let me make one other point about that.
Yes.
When I was as young as all of you, for years I traded 1-minute charts, 2-minute charts, and 3-minute charts. I cannot convince myself that I make any more money trading those charts compared to a 5-minute chart. And it was much more stressful. So To me, I prefer just to trade 5-minute charts.
Okay. What account size would you recommend to start with for trading one contract in swings only?
Okay, that's a common question. And the correct answer is as much money as you possibly have. Every trader starting out has limited capital. They work really, really hard to save up the money, and they want to know, what's the smallest amount that I can have that will allow me to trade and have a shot at becoming a professional trader. And realistically, if you have $25,000, it's better. But I know most traders starting out don't have that, but they usually have about $5,000, maybe $10,000, and even that is a little bit tricky. If I had a $5,000 account, I would trade Forex markets instead of the E-mini, and I would just look at the euro versus the dollar Forex market chart, 5-minute chart, and trade that. And I trade Forex markets, I trade bonds. I try to take at least one Forex trade every day. And the advantage of the Forex market is you can trade any size. You can trade 10,000 units, 50,000 units. You can trade really, really small. Yes, you cannot get rich, trading 10,000 units or 50,000 units. However, it'll allow you to stay in the game a lot longer. So if you're losing, you can last a lot longer trading the Forex markets than you can trading the E-mini. So back to your question, I think it's probably not worth trading unless you have at least $5,000 in an E-mini trading account.
Okay. Let's see. Let's see. 18 5-minute bars is 93/90ths or 23% of the trading day. Is the first 23% of larger time frames tradable in the same way?
Yeah, I think that's true. Markets are fractal, and that simply means that they basically behave the same on all time frames. And so if you're looking at a daily chart and you see any 18-bar trading range, it's going to be the same thing, right? If you get a breakout of an 18-bar trading range, you have at least a 60% chance of some kind of a swing up or down. Richard Dennis back in the 80s was a big-time trader. I want to say up front, I might have this wrong, Richard Dennis, I don't know if you've heard of the turtles. Linda Ratsky was one of the turtles. Richard Dennis had a Pygmalion theory that he could teach anybody to trade. And Linda Ratsky is one example of a turtle trader. He called his students turtles. And Richard Dennis was famous as a breakout trader. So he was always looking to buy new highs of anything, new highs of a range, new all-time highs, sell new lows of a range. And I'm specifically bringing up Richard Dennis. He managed hundreds of millions of dollars, but I believe that twice he had funds that went broke or bust or became untradeable, or he lost so much money with that style of trading that he ended up closing the funds. And again, I could be completely wrong about that. You're asking an old guy, me, to remember things that took place 30 years ago, but that's my memory. But going back to your question, charts are fractal, so you can use the same general ideas on any time frame.
Awesome, thank you. Are you using trend lines on the first 18 bars and looking for a break of the trend line?
I'm always putting lines on my chart, and I'm putting lines on. Most of the lines turn out to be useless, and I end up removing them. And a lot of what I do is I do visually. I don't even put the lines down because I know where the lines are. For example, if I see what appears to be a channel, a lot of times I won't draw the lines. In my chat room, a lot of times I'll draw it to illustrate points so people can see what I'm talking about. But as a trader, I typically do not put lines on the chart, or if I put them on, I erase them within a second. I just want to confirm that the market is at a line, and or if it's not at, is it close? And I typically, if it's a bear channel, I think of it as a bull flag. 75% chance you're going to get a bull breakout above a bear channel. I'm looking for the breakout, and if it's reversing up from the bottom of the channel and there's a decent buy signal bar and the context is pretty good, I'd rather buy the reversal up from the bottom of the channel before the breakout above the top of the channel. However, if the breakout above the top of the channel is strong, for example, if it has two big bull trend bars closing on the highs, if I'm not long, I'd like to buy at the market right around the close of that second bar. But as far as buying on a stop, one tick above the top of a channel, I usually do not do that. I usually get in earlier or get in later.
Okay. What is the second line on your chart, not the 20 bar SMA?
There's another blue line, and that is the 60-minute 20 bar exponential moving average. And I created a formula, it's on my websites, that allows me to plot exactly where the 60-minute exponential moving average, the 20 bar exponential moving average on the 60-minute chart, I can plot it on the 5-minute chart. And I think the 60-minute moving average is really important support and resistance. And it gives me more trades when looking at the 5-minute chart. So, I pay attention to how the market behaves at the 5-minute 20 bar exponential moving average and how it behaves at the 60-minute 20 bar exponential moving average.
Okay. When you trade and enter a position and the trade goes against you, do you add to the position to average in, or do you just hold and wait? Can you elaborate on averaging in and out, and what is your opinion of it?
I think that's a good question, and it depends on if I believe my premise is still valid. If I believe that my trade is still good and is simply pulling back, I'll very often look to add on. On the other hand, if I think that it's a reversal and my premise is no longer good, I'll get out. For example, let's say I buy a breakout, and then it has 3 consecutive decent-sized bear bars closing on their lows. I'm going to assume the reversal is stronger than my breakout and that my premise is no longer valid, and I'll get out. Let me say one other thing about that. A lot of hedge fund traders, a lot of the big name traders average in. Carl Icahn is a good example. I admire Carl Icahn. I think he's a really smart guy. He's in his 80s. He makes me feel young. And he averages in regularly. I haven't seen him on fast money in a lot of months, but I've paid attention to a lot of the things that he's said and a lot of the trades that he's taken, and they make really good sense. So, for example, I don't know, it was a year and a half ago when Freeport-McMoRan was falling and everyone was talking about it possibly going under because of all its debt. Carl Icahn bought it at $10, and it fell to just below $5. A lot of times he'll add on 5 or 10 times to a trade. And while he did not say he bought more at $5, I would be shocked if he did not. So he bought it at $10. It then lost 50% of its value down to $5. And instead of selling out in a panic, I'm sure he bought more. And then it rallied to over $15. So he ended up making a triple on his $5 buy and a 50% profit on his $10 buy. That's typical of value traders. They'll scale in. If you're a momentum trader, for example, the stock market right now is a big momentum market. Everybody knows it. No one's going to buy the first reversal down, right? If it starts to break to the downside, people are not going to be scaling in because people are buying now because it's going up, not because it's cheap. And if it starts to go down, they're going to say, oh, I bought because it's going up. It's not going up. I got to get out. They're not going to say I'm going to buy more. On the other hand, if a market is selling off and funds are buying it, they're buying because it's cheap. And therefore, if it sells off more, they're going to buy more. So you tend to scale in a value trade, not in a momentum trade. You don't want to be scaling in when the market is in a buy climax and reversing.
Okay, that actually ties into the next question. What percentage of the time do you place a full size trade as opposed to scaling in, or is it just based on market conditions?
That's once you've traded a long time, you tend to have a whole bunch of accounts. And I don't know how many accounts I have. I have accounts with all kinds of different brokers, and I don't think too much about position size. I have some default positions that I typically use, and sometimes I'll scale in, beyond my average scale in. But if I'm entering a trade and I'm expecting it to go my way, and I'm not thinking that I'm going to have to scale in, I'll trade regular size. If I'm entering a trade and I think I may get a deep pullback, but my premise will still be valid and my stop does not get hit, a lot of times I'll trade smaller and then scale in. For example, if we're talking about buying, I talked today about a bull breakout of the 18-bar range, and I said something very important. If you get that bull breakout, 90% chance the day is either going to be a bull trend day or a trading range day. And therefore, if I'm buying that breakout, I could be buying the beginning of a bull trend, or I could be buying at the top of a trading range, but only a 10% chance it's going to hit my stop below the bottom of the range. And that kind of a trade, if I'm buying high, I'm more inclined to trade smaller in case it becomes a trading range instead of a bull trend. If it becomes a trading range, I doubt that it's going to become a bear trend, and therefore I feel comfortable scaling in lower.
Okay. You briefly talked in your video course about converting swing trades into scalps. Is it possible to do the opposite and convert a scalp into a swing?
Usually, anything is possible, right? It's very common for swing traders to say, "Oh, this is disappointing. It's not turning out the way I wanted it to turn out. I'm just going to scalp out. Maybe take a small profit, maybe a small loss. I'm going to get out. I'm going to scalp out." That's very common. It's very unusual for a scalper to take a trade and then the market runs quickly in his direction and he says, "Oh, I'm going to hold this trade and turn it into a swing." Sometimes that'll happen. The only times I do that is if I'm taking a trade that I think will be, let's say I'm buying what I think will be a minor reversal, and I have a profit-taking limit order in there. A lot of times I'll put the limit order extra far out if I think there's a chance that the reversal could be very strong. So most of the time, if I'm entering as a scalp, I'll get out as a scalp. Only rarely will I enter as a scalp and convert it into a swing. Usually, if I think there's a reasonable chance of a swing trade, I'd rather think of it as a swing trade and scalp out part and leave the remainder on for a swing.
Okay. Let's see. Let me read it. Sorry, Al. There was a question I wanted, and people keep typing, so I'm trying to find it. Does it make sense to use this similar approach on other futures markets and not just the ES?
Yeah, the E-mini is based upon rational decisions, and all trading is based upon rational decisions. It doesn't matter what market. It doesn't matter if you're trading real estate market. It doesn't matter if you go to a flea market and trade. It's all going to be based upon rational decisions, and therefore the patterns are going to be the same. The patterns are just a reflection of rational human behavior.
Okay. How many trades would you take on an average day?
Well, when I was your age, I would take a whole bunch. It would be unusual for me to take fewer than 20 trades a day. And now, I'm finding myself taking fewer, but an average day I might take about 10 trades. Sometimes, someone will ask me, "Al, how many trades you take today?" And I'll say, I don't know, 5 or 6, and then I'll count them up and I find out it was 11 or 12. So invariably, I end up taking more than what I think I was taking. But in general, I take around 10. Some days 5, like when the volatility is very small, as it has been lately. Some days even only 2 or 3 in the E-mini. But usually it's between 5 or 10 and closer to 10. And if there are really big days with, I might take 20 or more, but that's unusual.
Okay. Are any of these stats and methods covered in any of your books?
Yeah, everything I said here. I pulled most of these slides from the trading course, and then I pulled a lot of others from a file that I use in the chat room. I have a file with hundreds and hundreds of, might have 1,000 slides in it right now to illustrate things that I'm seeing during the day. So I save patterns and I annotate the charts. And a lot of these slides are directly from that example folder, the file that I have in the chat room. However, everything that I said here is in the video course.
Okay. There's a tie-in to the question on the number that you take. How many of the trades would you say are swing versus scalps?
It depends on the context. If the day early on looks like it's going to be a very quiet day, the majority, if not all the trades, I'll scalp. And if the days are really tiny, like today, I'm scalping for 1 point. On the other hand, if the market is moving pretty well, I tend to try to scalp more. Anybody who tells you 2 things, right, that they take 10 trades a day or more, and that they often win 90% of the time or more, they're also telling you a third thing that they're not saying, and that is that they're scalping most of the time. Because the reality is, if you're taking a lot of trades, you're not swing trading many of them. And if you have a very high winning percentage, 80 or 90%, then you're scalping. And that has to be the case, because anytime you have a very high probability of winning, in other words, a very high winning percentage, you have to have a bad risk-reward ratio. And that usually means that the reward is small compared to the risk. And so hand in hand, high probability means small reward, and that means scalping.
Okay. There's a question on, out of the following trade titans, Wyckoff, Gann, Dow, Merrill, or Elliott, who is your favorite? Or I guess who would be somebody that you looked up to whenever you were getting started trading?
Well, the one I would definitely ignore totally, well, actually you get several. I would ignore pretty much every one of those, especially Gann and Elliott. I think they're fairy tales. So I wouldn't pay any attention to them at all. I would rather have someone read Warren Buffett, stuff from Carl Icahn. They really understand human behavior, and they understand rational human behavior. And I think you'll stand to learn much more about how markets work and how people behave listening to them. And I think the other stuff, Wyckoff had some good ideas, but Gann, I think Gann and Elliott are both idiots, I think both of them were idiots, and they were teaching religion and not science.
Okay. I'm just trying to make sure I got everything I wanted to cover. Do you still only trade manually and discretionary, or have you traded any, I guess, automated trading since your early days?
I don't know how long ago, 15, 20 years ago, 25 years ago, I used to, when automated trading came out, I did it a lot. I spent, I don't know, maybe 10,000 hours, writing systems and testing systems and trading systems. And invariably, I was always overriding the systems because I could see exceptions that were not programmed into the system. And so I do not have the kind of personality that would allow me to trade automated trading. So I think I'd be very good at working for a hedge fund, a high frequency trading fund, and giving them trading ideas that they could program. But for me personally to do it, I'm watching every tick all day long, and I'm thinking all day long about probabilities, risk, and reward in trying to structure trades. And I personally could not sit there while a system was unfolding, because I would always see exceptions and how to trade it better. A really good discretionary trader is always going to be better than a really good system, a really good automated system.
Okay. And this, I'll make the last question. What is your opinion on trading stuff like Bitcoin and the new these new items and things that are coming out?
I think it's fascinating. It's really interesting. Jamie Dimon says it's going to crash. China says it's going to be a flop, but I don't think so. However, I've looked at it myself, and from the little that I know about this stuff, I am uncomfortable about it, because I don't like the idea of having to carry around with me a long password to my wallet to get my Bitcoins out, because if my house burns down or something happens, there's just too much risk that something bad could happen and I could not recover my money. It's not like if you have the money in a brokerage account, you know that if something bad happens, you're going to get some or all of it back. As time goes on, I think what's going to happen is there is already an ETF for Bitcoin. I think the symbol is GBTC, like George, Boy, Tom, Charlie, GBTC. It still has low volume, but I think that as time goes on and Bitcoin becomes more accepted, it'll be like the GLD, the ticker for gold, and a lot of people trade GLD. And I think when the cryptocurrencies become really widely accepted, there's going to be tremendous trading in the ETFs, the cryptocurrency ETFs, and I will feel much better doing that than I do right now, trading the cryptocurrencies themselves. But will they stay around forever? The logic seems reasonable, but my general theory in life is, if you can't explain to me in one sentence what you're doing in a way that I understand it, there's something wrong. And for me to explain cryptocurrencies, it would take a lot of sentences, and even then I'm not entirely certain that I would get it right. So for me, there's something wrong with them, and I'd rather wait until they become I do have accounts, cryptocurrency accounts, but I'm very eager to have ETFs, the equivalent of the GLD, come out, because I'd much rather trade them. I feel much more secure with that.
Okay. Well, thank you for the webinar, for the information, and as always, most importantly, thank you for your time tonight.
Oh, you're welcome, Terry. And I want to thank everyone for being here. I also want to thank Big Mike and Futures IO.
Awesome. Thank you. Have a good evening.
Okay. Thank you. Bye-bye.